All right, let's dive into the world of index funds and uncover the secret that could potentially revolutionize your long-term investment strategy. Have you ever wondered why index funds have consistently outperformed most actively managed funds over the long term? So stick around as I unravel the mystery and reveal the keys to unlocking your financial success. My name is Isaac Jonas, and I like to talk about personal finance and investing. So, before we get into the details and the nitty gritties of what index funds are, let's define what index funds are. Index funds, they are an investment fund that aims to replicate the performance of a specific market index, such as the S&P 500, that is the ticker name SPX, and there are quite a number of them. Some of them they specifically focus on some niches like semiconductor sector, the technology sector, commonly known as the Nasdaq, and also there's the Dow, which mostly constitutes the top 30 most industrial companies. So now an index fund, now usually when I want to invest in an index fund, I would do so through investing through an what is called an exchange traded fund. For example, I like to invest in one that is called SPY, that is managed by State Street Global Advisors in New York, and it's one of the first ETFs that was actually introduced. And what it then does, it mimics the performance of the S&P 500, right? So now let's address the elephant in the room, the misconceptions and the barriers that often hinder investors for considering index funds. So some believe actively managed funds can outperform the market consistently, while others are concerned by the lack of the excitement, the thrill that comes with active investing. But what if I told you that index funds offer a simple yet powerful solution in these concerns? Number one, index funds are a smart choice for long-term investors for several reasons. Firstly, they provide instant diversification by holding a basket of companies, thus reducing the risk of individual stock volatility. For example, the SPY that I gave you an example of, it tracks the S&P 500 index, Standard & Poor's index, which is about 500 companies in the US which are publicly listed and they are largely capitalized. But sometimes it can go to 503 because there are some companies like Berkshire Hathaway, they have Class A and Class B, and Google, they have Class A and Class B shares, so it might increase, it might be above 500. But they cover specific sectors, technology sector, utilities, there's also the financials in different proportion, right? So in itself, an index fund, an ETF, is actually diversified in that regard. Secondly, index funds have lower fees compared to actively managed funds, allowing you to keep more of your hard-earned money. I have done several videos which specifically focuses on one index fund, each index funds, for example, in different sectors. You can check out several of those that you may be interested in on my channel here. And lastly, the simplicity of index funds makes it easy to understand and manage even for novice investors. What I've realized is that a lot of investors, even professional investors, they like to follow very complicated methods. Yet, in my view, what I've seen since I started investing in 2020, I just follow, simple strategies. And of course, yes, I've made some mistakes at the beginning of my journey, and I continue to make so. But I just have decided to focus mostly on index funds and a few quality individual companies that I really understand when they are really beaten down, and also some of the things that I'll describe in a bit. Now, let's shine the spotlight on a success story to showcase, the data, because the data doesn't lie, to just demonstrate the potential of index funds. And of course, this is the past, and it may not necessarily guarantee the future, because investing can be risky and things can change in the market. But at least from the history that I've analyzed from the data, imagine a scenario where, let's say, I had consistently added money into the SPY that tracks the S&P 500 ETF, right, for the past couple of decades. A report by Barclay Hedge Fund Indices and NYU Stern Business shows that the index funds, the hedge funds actually from between 2011 and 2020, the only 3 hedge funds actually managed to beat the S&P 500, right? And these include Pershing Hathaway, which returned 26.7. For those who know, it is the key figure there is Bill Ackman. He's a very popular investor. And then there's Discovery Capital, right? So you can see on this chart, right? And most of them, they couldn't even beat the S&P 500 in that case, because it returned much higher throughout, consistently over those years that they looked at the data. Even more recently in 2023, last year, S&P 500 returned about 24.2%, right, per year. And that was much higher than most index funds, and I will put them on the chart so that you see the performance of the different hedge funds in the US. And clearly they were outperformed by the S&P 500. So what it means is, if I had invested my money in the S&P 500, I would be guaranteed in that case to beat these other funds. But of course, what is important is to look at a longer time horizon, because for me, what I've realized is that it is very, very important to have a longer time horizon and consistently invest over time. That way, I take advantage of the dollar cost averaging. If the market drops, I add some more shares, and then over time, I continue to do that. Sometimes people even lose money because when the market drops, right, they start to panic and sell. So you find that even throughout those years, some people can potentially lose money. But for me, I want to have a long-term mindset. So now, in conclusion, the key advantages of index funds for long-term investors is that it offers instant diversification. It has lower fees, as low as 0.02% in some cases. Simplicity, also it makes it a reliable choice for people who may not have a lot of education to pick individual stocks. So remember, the secret to success in the stock market, it relies on staying on course and letting the power of compound interest work, because that's how the magic works. The money compounds. Let's say if it's growing at 20%, it keeps on compounding. Also, in my case, I also like some securities that are not correlated with the equities market. For example, the index funds, right? The stocks, right? I like to also just have some cash and also some fixed income securities. For example, just buying like treasury bills, or even, like I said, having ETFs that are negatively correlated. In other words, when the equities market drop, like that track the VIX, the volatility increases mostly when the S&P 500 drops and the market broadly, because people start to panic. It goes up, and what it does, it goes up in most cases from what I've observed. So that sort of helps me to hedge my portfolio. I also like to buy exchange traded funds that actually track gold. Like, for example, there's the popular one called GLD. Actually, it has returned somewhat, if you look at the 5-year return, somewhat even similar returns with the S&P 500. But what is very interesting is that when the S&P 500 drops, it spikes up. Like you look at 2020, 2022, and so each time that the S&P drops, people fly, the investors, they go to the gold ETFs and even gold per se to actually protect themselves from the market dropping. So I am so excited that at least this journey has really opened opportunities for me. So I hope you found this video helpful. If you did, please check out and share with me in your comments so that I can hear what are your thoughts. What do you think about index funds? And there you have it, the secret to index funds for long-term investors. has been revealed. Thank you so much for watching, and until next time, happy investing.